Hi, everyone. This is Rob Barnett from Bloomberg Intelligence. I am here with Shanu Mathew from Lazard, and we wanted to have a conversation to talk about the future of energy. We've seen a very interesting second half of the year when you look at the broad clean energy space. We've seen some names holding up pretty well in terms of the fundamentals, but we've seen some pretty weak 3Q numbers with some tough 4Q guidance. And so when you broadly look at whether it's wind, solar, EVs, batteries, space, how would you characterize where we're at the moment?
Yeah, thanks, Rob. As you mentioned, a really eventful earnings season, largely around the fact that, there are macroeconomic considerations that are impacting the outlook for a lot of these sectors. And so if we think back just a few years, right, a lot of these energy transition related sectors, whether it be solar, wind, batteries, all had the up and to the right forecasts or prognostications that they're going to be, invincible for the next few years. And I think what we're seeing is the natural fits and starts of a new industry or more nascent sectors where you're in a period where there might be a cyclical downturn for a little while. And so if we look across sectors, that includes solar. So you kind of have a bifurcated view there where a lot of the residential lever names I know we'll get into are seeing, a market downturn in terms of outlook and weakness in demand. And so you're seeing a lot of those names go down anywhere from, 40 to 70% plus. On the utility side, that those names have fared in a little bit better. And there's, idiosyncratic reasons for that to exist. But, solar, a mixed bag. If we look across EVs, it's hard not to find a headline today that isn't negative. But basically you saw players up and down the value chain talk about potentially weakening outlook. So EV sales this year are trending anywhere from 30 to 40% year over year growth, which is actually quite good. But looking forward, there's an expectation that the pace of the trajectory will slow. And so you saw North American OEMs walk back or push back targets. You saw battery makers that are based in Asia Pacific talk about weakening demand. You see battery materials that are down and stabilizing at lower levels. So lithium, for example, is down 70% this year. And so another mixed bag. And so if you continue to move other sectors, whether it's wind with cost inflation and contractual issues and project cancellations, specialty contractors, where it's a tale of two cities, where ones that are levered to onshore renewables are doing better, ones levered to wind are not doing well. You're seeing a really mixed bag in terms of the outlook. But the broader issue is that interest rates, general weakening macroeconomic environment, and overshoots of demand relative to supply are impacting these sectors.
Very fascinated by the idea of interest rates at the moment. And so I think the basic story, especially on the residential side, higher interest rates, most consumers finance solar, they're putting it on their roof. I think something like 90% of the projects roughly are financed. And so does the industry ultimately need lower rates to thrive, or will it adjust? Could it find its new footing at a higher rate?
Yeah, no, I think that's a great question. I think near term, companies will struggle with this period of higher rates, but I do think we will adjust to, call it a new normal. But businesses need to relearn how to sell their product in these environments, as well as rejigger their sales force and their overall pricing strategies, et cetera. So on the residential side, especially so, right, you have a lot of folks that the system sold themselves the last few years, whether it was net metering in the States or rapidly rising electricity rates in Europe as a result of the Russian-Ukraine conflict. And so now you need to re-educate your sales force on how to sell products where, you might be trying to push solar plus storage because the incentives are better there. You might be trying to sell a solar system on a lease or a PPA basis versus, outright owning it and financing, as you mentioned. And so that can adjust. If we look at like utility scale, you're seeing a lot of companies talk about their ability to generate good returns even with the higher interest rate environment. And so whether that's, some of your renewable developers, your renewable financing cos or yield cos, they've talked about being able to manage the environment and say that they can still pass on higher pricing to their PPAs. And so they might have actually, a quicker return to normalization or rationalization. I think what the market is saying is probably a little bit of cautious on both, just given the dramatic swing in performance you saw on residential, other pockets of Cleantech. I think people are taking a cautious wait and see approach on some of the utility stuff that appears to be more insulated.
Very interesting. So one of the ideas that I'm trying to get my hand around is just demand for solar probably going to increase about 50%, or installations. So capacity is just still ripping, but module prices have come down so much that a lot of companies are just kind of, despite fundamental demand growing something like 50%, sales maybe flat. And so if you kind of look out in this year, next year, year after, do you see a return to growth from a sales perspective? Are we going to offset the fundamental demand growth by price declines?
That's an interesting way to think about it at a sector level. I think near term, you probably see more price declines than you do, I guess, revenue growth at particular companies. I think over time, just in this period of rationalization, you will see, players with economies of scale or better pricing or, more capacity at lower prices start to go back to revenue growth. But players that, are uncompetitive on pricing or, have fixed costs and are now going to sell products at a much lower price than they previously have, they'll run into issues and potentially, have to consolidate or, be sold or cease to exist. And so I think, to your point, it's relatively at a company level about the economic pools and who captures those relative to the sector, which you mentioned, still really strong from a macro standpoint in a lot of these sectors. It's just a matter of, who's generating the economic profit there. And so that's to be seen. I think one of the interesting elements there is so much of capacity, whether it's solar, whether it's EVs, comes from China. And typically you have companies that, whether it's government support or national subsidies, can withstand periods of economic downturns a little bit better and, can invest in cash flow. So just the other day, you saw one of the leading North American lithium providers talk about the inability to compete with the Chinese and the fact that probably lose share in the Chinese because they're a Western manufacturer. They are beholden to much more, quarter to quarter, year to year fluctuations. And so they won't be able to invest as aggressively as the Chinese will in this period. And so I think you might see some share losses, whether it is solar or EVs or et cetera, up and down the value chain because they may not be able to compete as much in this period of economic downturn.
Interesting. What about the concept of inflated inventories? So particularly on some of the module players and inverter names, Enphase, SolarEdge, a big piece of the discussion is that their fundamental demand is actually growing at a reasonable clip, but the folks that they were dealing with on the other end of their equation just have warehouses full of equipment, and so they're not canceling orders, but they're calling and sort of saying delay a quarter or two. So do you see that settling out, and how do you think about this excess inventory, particularly in Europe? Yeah.
Just to take a step back to explain that inventory dynamic. I mean, it comes back down to overshooting demand, right? I think people underwrote 2022 in really favorable conditions in 2021 and said that this is going to happen again. So they overshipped into the channel, which you were alluding to, which is distributors and wholesalers. And now what you're seeing is, there are cancellations. We saw a few of the companies call out specific cancellations or not honoring deals that they previously had volume commitments for because of kind of liquidity concerns around distributors and wholesalers. And so, at least on the inverter side, some of the names are pointing to anywhere from 4 to 6 quarters, right? So this might take us through all the way to 2024. And anecdotally, you might hear from some wholesalers and installers looking at market data that the panel side is even worse, right? Some wholesalers have like a year plus of inventory. So I think to your point, a lot of it needs to flush out. And so you alluded to earlier guidance that was given where, a lot of companies that, were growing quarter revenue in, north of $500 million, north of $750 million are now guiding to $300 million. And so there is a significant correction, right, in the outlook. So when you look at it from like a stock or company perspective, if you were underwriting 20 to 30% growth and all of a sudden your growth is chopped in half, valuations compressed meaningfully. And so that's what you're probably seeing up and down the supply chain. So I think you do eventually get to the right sizing, but it couldn't be a multi-quarter issue depending on which subsector we're talking about.
I want to follow up more on the issue of valuations. And so for anyone who hasn't paid attention there, we've seen a big retreat. And so the median solar company roughly is trading at an 8x EV to EBITDA multiple right now. And some names are even quite a bit lower than that. And so I think we've really seen a fundamental shift there from kind of the growth narrative. And in many instances, these are trading like boring industrial elevator companies or something like that. And so is that the new paradigm, or do we eventually think of these companies as growth names again? Yeah.
I think that is the $1 million question is to understand how the market will perceive these companies again. I think just to take the devil's advocate of why shouldn't we value these as boring companies? Often the argument for solar, some of these growth vectors was you had such strong secular tailwinds. These were technologies that every business needed. We're bleeding edge, and then we hit our first or one of the first downturns, and all of a sudden it's commoditized pricing. It is cyclical. We have to flush all this out, and so I guess the argument would be why not value them like short cycle industrial businesses or businesses selling commodity products in some situations. And so to your point, right, like if you look at relative performance this year, the S&P 500 is up 15%. iClean, which is a broadly diversified clean energy ETF, is down 33%. The Solar Invesco 10, which is TAN, is down 40%. And so, meaningful absolute underperformance as well as relative. And then if you look at valuations, to your point, they've derated almost greater than 50%, meaning that, 2 years ago, something might be trading at a 20 times EV to EBITDA is trading sub 10 now. Or on a PDE side, 30 times to less than 15. And so that is quite changed a lot. And I think the market, based on what we're seeing this quarter, is that it's not rushing back to re-underwrite these names as growth names or give a lot of forward credit, just given from how we've seen performance go. I mean, you're seeing some companies perform mixed earnings and, be down 15%, which typically doesn't happen. But you're just seeing that relative skittishness and cautiousness around the sector.
So I want to talk a little bit more market segmentation. So you already mentioned that there is a disconnect between what's happening on the residential side of the equation and the utility side. And we could talk specifically some names there, but to just keep it more 30,000 foot, I think there's also perhaps a distinction between names that are geared towards the US or names that are geared towards Europe and perhaps names that are geared towards China. About 80% of the solar supply chain is in China today, but I think IRA and maybe other policies could shift that a little bit. So do you think there's a geographical segmentation component that someone should be thinking about when they think of solar names?
I do, but I think one of the things you saw, so this is more on the inverter side, was historically, the European market was growing a lot more rapidly, and obviously this varies country to country. But the growth rate overall for the continent was greater and expected to be greater into the future. You're still seeing installation rates be a lot more better in Europe, anywhere from double digits to 20% plus versus the US, which is tracking to be flat potentially or down next year. And so you still see pockets of growth there, but to your point, it really depends on that dynamic. Where if you're selling into wholesalers or distributors, that sell-through might actually be low given that inventory issue we mentioned. But if you're actually customer-facing, that's the installation number where you might see up. So I think it's less so geographic market, but probably more where you are in the value chain. And so are you going to see equipment prices come down and installations go up? And that's probably favorable for your business model. If you're going to see a period where you need to undersell into the inventory channel, then you probably are going to see depressed results until the inventory issues clear. But in general, I think you're seeing the European market on the residential side be a little bit stronger than North America. And on the utility side, it's probably the reverse, or at least I can't speak to the utility scale trends. I'm sure you're probably better at that than I. But the utility scale outlook for North America at least looks quite good for 2024, as well as beyond that. I think it's anyone's guess already. You don't have a crystal ball, but 2024 sets up pretty well, and you're seeing companies with backlogs executing them being handsomely rewarded.
Yeah, I mean, my general read, to kind of bring it back to interest rates, is just that utilities are doing a multi-decade optimization, and they're a little less sensitive to what the interest rates are at any given moment because they have a 20-year plan or often longer. So maybe they can sort of take momentum and go through a higher interest rate period without necessarily completely tearing up their CapEx plan. But I do want to come back to something you just mentioned on just kind of the European side of the equation, because I think over there, particularly in residential, you've seen some pretty high attach rates for batteries.
Yep.
And one of the things that I'm certainly thinking through, and you probably are as well, is this idea of, well, do batteries ultimately dilute margin a little bit, or are they going to figure out how to sort of grow the battery business in a way that contributes in a more positive way to margin growth? It definitely contributes to top line growth, but are batteries somewhat of a loss leader, or are we going to find a sustainable business model for that side?
I'm smiling because this is one of the challenges in trying to financial model some of these businesses, as you allude to. In general, I guess, depending on which part, so like let's call it relative to inverters or maybe other parts, batteries are lower margin products. So, some of the inverter companies boast margins in the 20% plus. This is gross, some 30% plus. And then you look at batteries, which are typically anywhere from 15 to 25%, depending on, which end market you're selling into and the pricing that you get. But in general, right to your point, this is margin dilutive on a gross basis. What the companies will tell you is that oftentimes you're still installing with the same same personnel, you're still selling to the same channels, same people are holding your product. So you're actually increasing the overall ticket price. you're taking a hit on gross margin, but from an operating margin standpoint, it's still accretive, right? Because you get some leverage on, additional top line, dilutive on gross margin, but you're not really adding much more operating costs in order to fill those same needs. So whether you believe that or not I think it depends on a company by company basis and how their costs are fixed or variable and their ability to flex that up, or what costs they bear in manufacturing and delivering their batteries. But in general, that's an argument I have. But I think it's hard to see a scenario where they aren't at least margin dilutive to some extent, perhaps on both gross and operating margin.
So let's switch maybe just outside of solar. I know solar is your comfort zone, but Vestas reported this morning, and it's one of the companies I cover, and so I'm quite interested in what's going on with them. And I think, despite all the headlines you've seen about project cancellations and sort of headwinds, particularly for the offshore segment, Vestas and some of the other players actually have a pretty good story. And so the way I'd characterize it is growth kind of paused starting in 2021. It retreated on an absolute basis in 2022, but we're actually back to sort of a growth story, kind of mid-single digits for this year. Next year is probably double digits for a number of the players. And so even though maybe some of that long-dated project pipeline is in question with the offshore segment, 2024, 2025, 2026 looks decent, and they actually upgraded their margin guidance as well. So decent story. And I guess solar, some of the best names out there might have EBITDA margins in excess of 30%. For wind, like a good operator gets to maybe a 15% EBITDA margin on the equipment side. So is there any fundamental reason in your view that sort of should solar and wind have divergence on profitability, or can wind be as profitable as some of the best-in-class solar names?
That's a great question. I'm not as comfortable in the wind sector, but I would have to assume, just given that the delta in that margin profile, that there are just idiosyncratic things unique to the wind industry that does not allow them to generate that level of return or margin. And I think we think about competitive markets, which these very much so are in power and energy. It's ruthlessly capitalistic. You're getting down to the lowest possible margin that allows you to generate a good return. And so if that's where the industry's settled, I'd see it hard to see, a sector re-rate to that level, right? I mean, we're talking about doubling or tripling of margin. So it seems like, those two might have to be trading in isolation or, viewed very separately versus even though we consider them both in the power sector. That's my, you're a lot closer to the name. So,
so I guess maybe to flip it around and bring it back into solar. So look, Enphase is a name that's historically done very well from a gross margin or EBITDA margin perspective. First Solar as well. And one of the really interesting things about First Solar, and I know we don't necessarily want to go into individual securities on this call, but they have a big backlog, right? And the backlog's locked in at a pretty high price point. And so for some of the names that generally have decent contracted pricing, do you think that as those contracts roll off, they're going to have to be much more competitive in sort of kind of few years out because of what's been going on the pricing side?
I'd say so. I think near term, it's all about backlog execution and your ability to execute and get the pricing that you said and actually deliver these projects on time without delays. But yeah, I think going forward, right? I mean, if you have an industry that has oversupply of certain components or materials, that presses prices downward. It's hard to see where you could have pricing power beyond that if the rest of the industry is pushing lower. I mean, obviously, right, the ways to get around that are technological advantages, and that's what we consider a moat. But it's harder to see in some of these commodity markets. I think you pointed out a good case in solar, where the conventional domestic player of scale has a slightly different technology than Chinese polysilicon, and so that'll be a good test. I think if you're bulled up on that particular technology, then you're probably very comfortable owning that name for a long period. If you have the view that there is not going to be a premium and that people are willing to pay the lowest market price, then you're probably a lot more bearish. So I'd say generally I probably err on the side of, I think that again, these are all personal views, but it's hard to see an area unless there's serious technology advantage that you can get pricing power converge to the broader market prices. But that's something that we'll definitely have to see.
What about business strategy in the sense that and again, this is just an example, but Canadian Solar really is an example of a company that is vertically integrated in the solar space. They really kind of do from polysilicon all the way through project development. And then you've got some names like First Solar, just that they're specializing just on models, or modules. So from a business model perspective, is it better at the moment for companies to sort of focus in individual pieces of the market? Or do you ever see a point when some player that's kind of just doing the full spectrum will be thought of as the right way to do it?
Definitely. I'd say, at least in general, it seems like especially in these periods of economic challenges for some of these businesses or sectors, it appears that being vertically integrated probably gives you better pricing power and the ability to consolidate costs better, right? You have more leverage, you have the ability to control costs in your company. And so, like, an example I'll give you, for example, is I mentioned lithium earlier. That's down considerably. Typically in a commodity market, right, the market price is set by the marginal cost producer. And so in a sector like that, you're seeing production go offline of folks that are not vertically integrated. And this is particularly Chinese lepidolite in this example. But those that are vertically integrated have lower costs. So their ability to stay online, even though the prices are depressed currently. So at least in that particular situation, you're talking about a vertically integrated company having advantages. If you look to, I guess, the broader EV space as well, right? I think there's a tale, again, of like two cities where you have some of the newer OEMs that may not be as vertically integrated, outsource some of this, and you can sell it from suppliers, start to walk back projections, whereas the players that have a vertically integrated supply chain are in a position of relative strength right now. It doesn't really help all that much if the broader sector is going to be weaker, but that does give them a relative advantage in the near term. So at least for now, it seems like scale is your best friend, but we'll see if that changes in the future.
Okay. We're approaching time here, so maybe end on sort of big picture question. And for years, if you look at the IEA, International Energy Agency, whenever they would sort of think about solar or wind or electric vehicles, it would kind of have these funny looking forecasts where it'd be going up through time, and then they just kind of draw like a straight line off and sort of say, like, we've reached the potential. And now I think they've switched gears a little bit and said, hey, well, solar and all these things are going up fast, and maybe they'll keep going up fast. So I guess sort of just philosophically, does clean energy still have like a big runway ahead of it over this sort of 5 to 10 year time horizon, or are we starting to hit up on constraints within the system? For example, I believe that if we keep going at our current pace, particularly I've heard in China, it's not too many years out before we just simply run out of roof space for the solar industry. So, are you worried about anything like that that's just kind of looming in the background that might sort of surprise people who think it's just going to keep roaring away?
Yeah, I think to your point, like on a 5, 10, 15-year timeline, I think we have plenty of runway in a lot of these areas, right? If you look at like the global penetration of electricity that's renewable or global penetration of electric vehicles or whatever have you, there's definitely room in terms of the overall growth of the market. And I'd expect us to get there. I think it's a traditional technology S-curve where we're probably overestimate the potential in the near term and underestimating the long-term potential. And I think we're probably very much in a situation there. That being said, you probably are going to start seeing just the law of large numbers appear, right? Whether it's, China's a lot further ahead in EV penetration. You alluded to rooftop penetration. For example, the Netherlands and Europe is a heavily penetrated market. It's been historically a really strong grower. That might, tail off or start to plateau or go at a slower rate than before. So I think to your point, people are starting to ask themselves those questions, whereas previously you might have underwritten the entire sector saying this is going to grow at double-digit, compounded annual growth rate into however long you're investing for. All of a sudden, you might be getting a little bit more granular about which markets you're expecting to go and where penetration rates are today versus where they can go theoretically in terms of a maximum or what you're willing to underwrite. But you bring up a good point. And so I think, again, I think without a fear of overgeneralizing, we have a lot of runway, but it definitely has to be selective about the market and technology. Okay.
So I think that's going to be a good stopping point. You're active on Twitter. Tell everyone how to find you on Twitter. I'll tag you in the video, but you can.
You can find me at Shanu Mathew 93 at Twitter. Always looking to engage in thoughtful debates or dialogue around the energy transition.
And also, I would note that you are regularly a green dot on the terminal. So I don't know hopefully no one will take too much of your time, but you can shoot them an IB as well. And you're always welcome to shoot me an IB or find me on Twitter or LinkedIn or any of the various places where I spend some time. So great to chat with you.
Yeah, thank you so much for having me.
Cheers.
Pleasure.